Hello everyone, welcome to the No Nonsense Forex Trading Education Program. Here we'll be talking about stuff that's not based on the normal nonsense stuff that you see talked about in the trading platforms. We're going to be talking about stuff that works over a longer period of time. I'm not going to be promising you very quick wins, millions of dollars in the next 24 hours. Maybe it can be done, but very rarely. What I'm going to speak about are things that you can probably employ in your trading strategies, which will work over time. For me, it's a marathon, it's not a sprint. The strategy we're going to talk about today is based on an indicator from the East. It's called Ichimoku. Now, if you have never used this indicator, the moment you will put it, it will look horrendous because there's just way too many lines. Now, without going into the details of what every line is, and you can probably find a lot of videos on explaining what exactly these lines are, how they are calculated, and what they work as, I'm going to be focusing more on the strategy here. I don't need the lagging span, and I don't need the conversion line. I do need the baseline, and I normally color it as blue. Now, one thing to know is that the leading span B and the leading span, the baseline and the leading span, they work as support and resistance. Leading span A does not really work as support and resistance. I'm not going to go into why and why nots. You can probably find a lot of videos on that. We're going to talk about the strategy. So this is a support line and this is a support line. Now, the way the strategy is going to work, what I want to see is the price going from either below to up, above the cloud, or coming from above the cloud to below the cloud. And I want to see the price entering the cloud, crossing the green line, which is not a support, and exiting the red line. Remember, the red line is our span B. So I want the price to enter through span A and exit through span B, whichever direction it is going. So, for example, here, for example, the price enters the cloud and exits the cloud. It enters the cloud with span A and exits span B. So my trading criteria is met in that sense. So that is the first criteria. I want the price from above to go below, entering the cloud through span A and exiting the cloud through span B. Why through span B? Because this is a support level, and if it is broken, that means the support is broken. So I can expect the price to continue downward. The second criteria I have is I want the price to actually come from above and enter and exit below rather than coming sideways. I don't want a sideways movement. So for example, if this was today, the price enter and exits, but because I can see that it has been a choppy action, it has been a sideways move, I'm not interested. I want to see the price to go like this. So for example, here, the price enter, the price come down, enters the cloud through span A, the green line, and exits through the red line. And it's coming from above to below, it's not coming sideways. That satisfies my requirements. So once again, 2 requirements, or if you really want to talk about it, then 3 requirements to enter a trade. The price should come from above to below or below to above, depending on whether you're buying or selling. It shouldn't come sideways. It should enter the cloud through span A and exit the cloud through span B. And it shouldn't be a sideways movement. Once those conditions are met, you can enter the trade. Now, one thing which I will say about Ichimoku, it works better on higher time frames. So if you're using it on 5 minutes time frame, it will work better on 15 minutes. It will work better on 30 minutes than 15 minutes. It will work even better on 45 minutes than 30 minutes. I think you get the drift. I would normally say apply it around day or week chart to be more profit or to have more success. The lowest I would suggest to go with Ichimoku strategy is 4 hours. I wouldn't trade it below. I wouldn't go for 2 hours, 1 hour, 45 minutes, 15 minutes, 5 minutes. I'll use it, for example, on a daily base, on a daily chart. So let's just scroll back, for example. I mean, here I see that the price has a choppy action. So here I wouldn't have been interested in taking a strategy anyway. I think the first time this actually, the trade meets my requirement. It doesn't meet my requirement here because yes, it enters the cloud, it exits the cloud up, but it comes sideways. It's not coming from below to up. So not interested. Then it continues. It tries to come down, but doesn't exit. Hits the support line, go up, and then comes back and breaks the support line. Now, my requirements are okay because the price is coming from above, or it is coming from above the cloud, entering a span A, leaving a span B. I would have entered the trade here. So just because I say I would have entered the trade here, let's assume we entered the trade here. Now my stop loss is going to go above the blue line. Once again, the red line and the blue line, they act as support and resistance level. So I will put it above the resistance level. The good thing about Ichimoku is you can actually set the trade, the take profit, the profit to risk, you can actually set it very high. I mean, you can probably even go 4 times, 5 times. Try it, backtest it using 2 times, 3 times, 4 times, 5 times. Because the idea with Ichimoku trading is not to have too many successful trades. You're not looking for a 80%, 70% success ratio. What you're looking for is setups where you enter, and if the price goes in your direction, you make a kill. I normally, over the last 3-4 years, what I have used is 1-to-3 risk ratio. Now, if the stop loss is very big, then I might actually go for 1-to-2. But if the stop loss is tight, then I would normally go for 3. Once again, coming back to the point, the idea with this strategy, the Ichimoku based trading, is to not have too many trades and have too much or have a huge success ratio. You're probably looking for 50% success. But what does happen is if you have 50% success, your return is 3 times your loss. And you will probably see it as we go along. So for example, so we make this successful trade, then the price continues in our direction. I mean, you can see it would have probably hit 4 times, 5 times, even 6 times the profit ratio. Then it turns back and it starts to come up, and then it enters the cloud, and then it exits the cloud. Now, are our conditions met? Well, to me, it looks like yes. The price is not coming sideways. The price is coming from below to up with certain pullbacks. It enters the cloud with leading span A, and it exits the cloud with leading span B. My conditions are met. So here we go. Let's jump in. At the close of this candle, when we have confirmed that the price is above the cloud, it has met our requirements. I'm going to go in, and my stop loss is going to be right below the blue line, under this candle. I'm not putting the stop loss here, I'm putting the stop loss here because with this candle, this blue line would have been here, the base indicator. And we're going to go for 1-to-3, depending on, once again, because here the stop loss was very tight, here the stop loss looks big. I might actually go for 2.5. But let's just, for consistency's sake, say, well, nah, we want 3. So we go for 3. And coincidentally, it looks that we might have actually made another profitable trade here. Guys, this is not the norm. You're not going to have you're not going to have, 80% success ratio with Ichimoku. What you're looking for, once again, is when it hits the stop loss, it's a small loss, but when you gain big. Anyways, let's continue. Let's see what happens next. Now the price remains up, and there you go. The price is coming from above, and it enters the cloud through span A, and it leaves the cloud through span B. So a valid setup in my book. And we go short here. Now the way we're going to set up our stop loss is going to be right above the blue line. I should move the right above the blue line, somewhere around here. We would have entered on this, so yeah, this is where I would have put the stop loss, and our take profit would have been 1 to 3. Well, that's good enough. Okay, then we see what happens. The trade goes, I think it hits our stop loss, and we make a loss. Happy days. The point is, again, when you make a profit, you make a big profit. When you make a loss, you take a small loss. Now the price comes down, then goes up. Now, is the price coming from down? Well, I don't know. Now this is where the subjectivity comes into place. If you just look at this, then you might argue that it's coming sideways. But if I look from here, if I remove this, right, and I look from here, the price is actually coming from below, and it enters the green line, then it exits the span B, which is our base. So here it's a valid setup for me. So we enter a long position at the end of this line. We set our stop loss below the blue line, and we put our profit target at 3 times. Let's go further up, and we go, our profit is 3 times the loss. This, I guess, would have hit the take profit here. Well, this is quite unusual actually, that we have 1, 2, 3 profitable trades versus 1 loss trade. Normally, I would expect the Ichimoku success ratio to be around 50%. Would be a very good ratio. Anyways, the price goes up, up, and this is where it enters. It comes and it enters the span A, it leaves span B, and then it closes B. Now, yes, that condition is met, that it enters the span A and it leaves the span B. But to me, it doesn't look like it's coming from above. If the price was coming, I would have wanted the price to come like this. But since that has not happened, I will not enter the trade here. For me, it's a sideways it has come. I mean, it's up to you. I mean, if you consider this to be coming down, then you can enter the trade. I wouldn't enter the trade here. Then we continue. Now here the price tries to come, the price tries to come back up, doesn't exit, goes down, and here, yes, it comes from below. It enters span A, it leaves through span B. Again, valid setup for me. So we enter the trade at this point, and we set our stop loss below the blue line. I would give it a little bit more because it's very, I don't like way too tight stop losses. And our take profit would be 1:3. Somewhere around here. Well, fine. Somewhere around here. And by the grace of luck, very unusual, we would have had a 4th trade in success. Well, this would have also been a successful trade, but just I'm going to stick with my criteria. To me, this is a sideways movement, not a up to down movement. This would have been a successful trade as well otherwise. But let's just stick to our point, our criteria. Now it looks like the price from here now is coming from above and is entering the cloud span A And if it leaves the cloud as span B, it will be another good setup. And there we go. We have another setup. Now, without looking ahead, I think this is going to be a loss because the price closed way below. Now, if the price is so far below, then I'm not going to be an idiot and try to put the stop loss above blue line. I would put it above the red line because fine, this is my first support resistance level. I'm not an idiot to take like hundreds and thousands of pips of risk. So I would put my stop loss above the red line just because the stop loss would have been way too far. I'm not going in for that. I will set up, or I will just not take this trade because the price, yes, it does what we wanted it to do, but it has closed so far below the red line that probably, I mean, just the stop loss doesn't make sense. Or if I really want to take the trade, then I would not put the stop loss above the blue line because it will be a huge stop loss. I will put it below the red line, the first support available. Now let's see what happens. And yeah, there we go. We hit a loss. Well, this is where I think I will end the tutorial, but I mean, you can go even further back. Here, the movement of the price is all very choppy sideways, wouldn't have been interested anyways. Here, the price never exited the cloud. This would have been an okay setup. Yes, it comes from above. It enters the cloud through the green line, the span A, and it exits through the blue line. Here on this candle, would have gone in. Would have put the stop loss. I don't want to put too tight a stop loss, so maybe somewhere above the blue line. And a profit to loss ratio of 3. Now, well, in hindsight, of course, I can see there is a spike, so I'm putting the stop loss above. But let's say if I have put the stop loss above the blue line, yeah, it would have been a stop loss hit, and our profit would have been, so we would have a loss trade. Well, Forex market is like a girlfriend. You know, sometimes it acts up, sometimes it does these stupid things of spiking up for no reason, moody, maybe it was on PMS or something. The other trade setup that I see, okay, the line, it came from here, entered, but I see a sideways movement. The price is not really coming from here and going above. It entered from below, but it actually exited sideways. So not a valid setup for me. This is a valid setup for me. The price comes from above and it enters below. It enters through span A and it leaves through span B. So I would have entered the trade here. At this point, would have put the stop loss above the blue line and take profit somewhere close to 3. Well, this would have been a good trade as well. Look guys, overall, if you see, we have one successful trade where we made a lot of money. Then we had a stop loss hit, but it's a very small amount of money that we lose compared to how much you gain. Going forward, you don't have any trade here, not have any trade. Well, you could have entered the trade here, which would, fine, okay, let's put it here because here our criteria is met. The price is coming from below and it's leaving or is exiting the cloud above, entering through span A and exiting through span B. Our stop loss would have been below the blue line. Our take profit would have been to 3. And we would have lost this trade as well, even though it subsequently went in our direction. Well, it didn't really, because you see, it went all the way up to here, but it never really hit our. So this would have been a loss, but a smaller loss compared to when we make profit. Then we make profit, and we make quite a big profit. Then we make quite a big profit. Then I think we take a small loss here. Yeah, this would have been a loss trade. We take a small loss. And then we make a huge profit. And then here Well, if you had entered the trade, you would have made some profit. I wouldn't have entered the trade here because to me the price is moving sideways. Well, you can argue it's coming from above to below or it's not coming from above to below. I wouldn't have entered this trade. And then here we would have made a huge profit. So overall, I think, and here we would have made a loss. Quite a big one. Oh, but the point is, overall, guys, Ichimoku, do not expect a huge win percentage. What Ichimoku does give you is when it goes in your direction, it goes big in your direction. So even having a 50-50% success ratio is gonna give you a lot of money, because every time you make money, you're gonna be making 3 times the money than when you lose. So you will be in profit. I think, overall, you probably can have a success ratio of 30% and it still be break even. So anything above 30% will give you profits. Now back to the point, it works better on longer time frames. Now the bad part about that is, this trade happened on October the 5th, 2021, and then the next trade you enter is on 26th of November, so it's a month apart. But there are lots of different pairs that you can look at. You can go to CAD JPY. Okay, here, the price entered the green, left the so our conditions are met. At this candle, we take the and we put it below the blue, and we go for a 3 times success. And by the grace of the gods of trading, have been very kind to Ichimoku. It would have hit your TP here. So you will have fewer trades, but the trades that you can have different pairs that you can apply this strategy on. Now it works even better on weekly, because on weekly, say for example, the price is coming from below, it enters and it exits. So this probably is here where it would have been, the setup would have been valid. You would have entered the trade here. Why not here? Because here it entered the red line first and exited the green line. Remember the span B and span A. So it entered the red line and then exited the green line. Not valid. It's coming from below, and when it here it enters through the green line and exits through the red line, the span B. So here would have been a valid setup somewhere around here, and your stop loss would have been below the blue line somewhere around here. On weekly charts, you do want to give yourself some leeway or some margin, and you would have gone for, I don't know, maybe 4:1 ratio. The only problem with the weekly chart that you're going to have is you're going to have your trade in October 2020, and then you will not have any trade for God knows how long a period of time. So it's a balance between how frequently you want to trade versus, but I wouldn't go below 4 hours for Ichimoku. Then it just doesn't make sense. It just becomes way too chaotic. The best that I've found for myself is 1 day. And on 1 day, you can look, basically here you would have had a losing trade. So here the price is coming from above. It goes down and you would have entered the trade somewhere here. Your stop loss would have been above the blue line. Your take profit would have been 1:3, and that never happened. So you would have had a loss somewhere here. But on the other hand, here is a trade setup. Let me make it bigger. It's not a trade setup at this point in time because here our conditions are not properly met, but here the price is coming from below. It enters through span BA and it leaves through span B. This would have been a good setup for me, and I would have entered the long position at the end of this candle. A stop loss below the blue line. Do give it a little bit of space, and I would take profit to be 3 times. Well, looking at it, you can actually see, I mean, 3 times is nothing. I mean, when it actually goes in your direction, following Ichimoku, it can go 5 times, 6 times, 7 times, 8 times. So that's the idea, guys, that you want to enter Ichimoku based on this setup. But what you're looking for is that if the trade goes in the opposite direction, then you have a stop, then you have a minimum loss. But when it goes in your direction, my God, I mean, yeah, you can probably go for 10 times. Now, if you go for 10 times, of course, your win percentage is going to be even lower because not every time is going to go 10. But it does, I mean, just put this on a chart and go back and look for yourself. When it does enter your setup, sometimes it just runs. And you want to capture all of that, or at least 3 to 1. But coming back to the point, I mean, yeah, the amount of trades are not going to be that many. So you will be entering probably a trade on one currency pair, probably around like once a month. But then there are so many currency pairs. Anything else on this? I cannot think of anything else. Leave down your comments in the comments if you have any question on this. Let me know any ideas. I mean, if I can be a bit more clear in the way that I explain things. If I'm speaking way too much, should I shorten the videos? I like to give many examples. I mean, look here, how many trading setups that we look at? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 trading setups on a currency pair. Potentially even 11 if you consider this one. Guys, I will be posting more videos, so stay tuned. Hit the subscribe button so you don't miss anything. It also helps me because as the subscription number grows, the channel becomes more popular. It comes up in YouTube more and more, and then together we can help people more. So hit the subscribe button, leave a comment, and hit the like button if you like the video, and I'll be coming up with more. Ciao guys, stay profitable, stay safe.